Shares of Deere Co are up 11% today after the company raised its fiscal year outlook and said demand in the construction and small agricultural markets was recovering. Despite the beat, our next guest still maintains a short rating on the stock. So let's welcome in Jay Van Sciver, partner and industrial sector head at Hedgeye Risk Management. It's good to have you join us. Thank you for your time.
Thank you so much for having me.
So I'm wondering why the short rating after what we're seeing today. Is there some areas of weakness that you think are being overlooked?
Well, first, this is a seasonally not that important quarter. So a lot of what they've seen so far in 2026 isn't all that representative of what the year will be like. And you started to hear them point to biofuels. And what you've seen over, say, the last 5 years is a topping out in ethanol demand. Corn-based ethanol is the most important market for ag and therefore for Deere's capital equipment. And that is something that is going to, I think, enter secular decline as electric vehicles take share in the fleet.
Interesting. Okay, so the company referenced cost-cutting initiatives to protect margins. Did they specify any particular measures at all?
Well, I think they mostly pointed to the macro environment, this idea that the USDA is expecting revenues to be up, farm revenues to be up, farm income 3%, and a lot of that is related to government transfer payment and government support in the U.S. I think what you're looking at primarily is a company that reported a pretty good revenue quarter, actually, and down EPS, down almost 25%. So when you have revenue up and sales down because you're cutting price and margins are narrowing in your best segment, it's a difficult story. So typically in that environment, they're going to turn to cost cutting.
So I do take your point on why maybe investors should be looking at this a little cautiously, but Deere has raised its fiscal year outlook, citing recovering demand in construction and small agricultural markets. What factors do you think are maybe contributing to this turnaround?
I think the reason they gave that guidance is that they're hosting Analyst Day in about 2 weeks. And the last thing a public company wants to do when heading into an Analyst Day is, cut guidance or give weak guidance into what's a crowd that will basically contain all of their fans and all of their critics. So when you have that kind of near-term, event for a management team, there's a real incentive to give a rosier outlook for 2026 than maybe you would have in the absence of it.
Okay, so you're a little bit skeptical about that guidance then, is what you're saying.
Sure. No, I mean, ConExpo is a very important event across the sort of manufacturing and construction equipment industry. And Deere hosts its Analyst Day at that event. That's a big Analyst Day for them. And I think you've heard this company for the last several years tell you that ag is bottoming, and ag continues then not to bottom.
Mm-hmm. Tariffs imposed by President Donald Trump have also kind of affected profits in the past for John Deere. Do you expect that will be any different for the year ahead?
Well, I think you have a lot of potential interesting factors on tariffs, like the Supreme Court's IEEPA decision may come out tomorrow, an important catalyst where they will decide whether or not the implementation of Trump's use of that is appropriate given the law. And then there's also a factor around Chinese purchases and whether they actually follow through. We've seen a lot of purchase commitments over time that haven't quite borne out in the way investors expected.
It's interesting, too, when you look at the company's growth, which slowed since 2024 before tariffs were actually implemented. So where do you think that kind of drop off was coming from before?
I think what you've seen is the topping off of ethanol demand, right? That's when you start to see electric vehicle sales pick up. Then you have an effect in terms of just total land value, leverage access. It affects the amount of equipment that's actually on acreage. I mean, the real effect of all of that is it takes down used equipment values. So when you go to trade in your combine or your tractor, you end up with the negative equity associated with your loan on the new purchase payment and higher interest rates. These are all sort of compound. These are all very big positives on the way up and have been significant negatives on the way down.
So you've talked at the top there just now about more electric vehicles coming on the market, maybe affecting John Deere's growth. Is there a way you think the company should be kind of pivoting and adapting to some of these changes?
Yes, you're seeing them do it. They're getting out of farm equipment and into excavators. They're trying to make more construction equipment. They're buying companies like Wirtgen. I guess they bought it a little bit ago, but not that long ago, to diversify away from their sort of core market of large ag, these sort of cash crop markets. Ethanol, or corn, soy, and wheat are their big markets, and their two big geographic markets are the U.S. and Brazil.
Just lastly, before I let you go, there's a lot of AI-powered farm equipment coming onto the market, like autonomous tractors, precision agricultural platforms. I think you touched on this, but how is the company maybe working to accelerate that?
I mean, they've been investing in sort of machine vision, autonomy, things along those lines for a long time. And Deere deserves some credit for being forward thinking in their embrace of sort of technology. Retrofit kits are an interesting way to deal with weak used prices that they've adopted, where you can get some of these technologies on existing tractors, in a sense, kind of hurting their future sales, but to maintain a relationship with the customer. I think anytime you have a significant disruption in a market like this, where you have a new technology emerge, there's risks for the established player like Deere, and I think they're doing their best to stay ahead of that. And farmers are not the earliest adopters of technology, but it is, I think a potential source of competitive, pressure. You could see a new entrant come in with a new autonomous solution that's more advanced than Deere has. I haven't seen that yet, but that's a risk for them.
Okay, very interesting. We will leave it there. Javen Sciver, partner and industrial sector head at Hedgeye Risk Management. Appreciate your time today. Thanks for joining us.